So this is going to be a session on pitching fundamentals and understanding what to do for demo day. When you walk away from this session, or when you click away from this session, what I want you to remember is this. Your pitch needs to be clear, it needs to be concise, and it needs to be convincing. Each of this is extremely important. And if you fail to do anything, as long as someone can understand the basic premise of your pitch and someone has the confidence that, hey, okay, I think this guy, I'm not exactly sure what this guy's solution is, but I'm pretty convinced that, they have a good solution, or their solution kind of like, makes sense. And I'm also quite convinced that these are the right people to do it. So yes, your pitch needs to be designed to be clear, to be concise and convincing within like a short amount of time. And because your goal of the pitch is not to like seal the deal right away, it is actually to get investors to be interested in you, to come and talk to you after that. You have to consider this from their perspective. 10-minute elevator pitches are not a thing. They go for pitches day in and day out. They want something that is quick and they want something that is exciting for them. The goal of the pitch is very, very simple. It's to get them to talk to you. These are the impressions that that you want the investors to leave with. After your pitch, they should be thinking that, okay, these people are solving an important, large or unnecessary problem. Their solution is creative and all feasible. It doesn't have to be the best solution out there, but it's actually done in quite a smart way, or that is very feasible to implement it and scale it. And they also can go away with, okay, their team seems pretty, well equipped and skilled to take on this challenge of running this startup. Even if you see in Shark Tank, the pitches in Shark Tank are actually just 2 minutes long. The Q&A and the drama that follows is the bulk of the show, and that is basically what the essence of the pitch is to get them to ask you the right questions and to get them interested so that you are able to continue the conversation. So according to Y Combinator, another way of understanding this is after your pitch, the investors need to understand your idea. They need to get excited by the idea and they need to like the team. So how Y Combinator puts it is that if the pitch leaves an impression such that I can go to a dinner table afterwards and have a conversation about your team, and say like, hey, these guys are pretty interesting, they're doing this and this. That means that you have managed to let them really understand what you're doing. And also they're pretty excited by it because they're sharing it with others. And they have enough confidence in you that, if they're recommending you, if they're talking about you, you won't close the company in like the next 1 month or something. Before you even start drafting your pitch or having a narrative of sorts, you really need to know your audience. You need to understand and ask yourself like, why are they listening to you in the first place? So if they are impact investors, why are they listening to you? Are they listening because you have a particular solution that they are interested in? If so, you need to identify them early on and try to have conversations with them early on. And also you need to understand what motivates your audience, right? Most of them are investors, means there is some sort of return they are looking for. And also you have to understand what your audience do. So this goes back to my point earlier, where your audience are essentially listening to pitches day in and day out. If you're not going to keep it short and succinct and also going to convince them on that you are the right team, they're probably just going to move on. They have tons of other people they would like to talk to. If your audience, an entirely different group of people, let's say people from foundations who are looking to give grants, then this will be a very different approach you will take. You will not focus so much on what the returns are, what the potential to scale is, but you'll focus on what exactly is the impact that you're generating, and of every dollar of amount they put in, what impact can you generate? If you watch like pitches online, or even if you go to YouTube and say how to make a good pitch, a lot of them focus on, okay, here is the structure. You need to have a problem, you need to have a solution, blah blah blah, and then they will tell you like, okay, convince the investors that you can 10x this in 5 years and things like that. But the thing is, most of us here, we are impact startups, so we have an added challenge of conveying both our impact as well as our business model, as well as our revenue. Here is one possible angle that is recommended by one of the Duke business schools. There are 4 main ways you can tell your investment story. And you need to understand what your investment story is early so that you're able to prioritize the right things and to convey the right things to the audience that is listening to you. The first angle is basically a high growth opportunity. So this is the typical startup angle, which does not have much focus on impact. What this means is you have a huge market opportunity that you have identified, and you have customers who will be able to pay you a lot of money or there is a sizable customer base, you are also exploiting a possible impact opportunity. Second type of investment story is innovation play. This is the one that is getting like a bit of traction these days, which is basically companies which goes and says, we know this industry, we are going to disrupt this industry, and we can do it because we have this amazing and innovative solution. Going for an innovation play does not mean that you have to kind of neglect your impact, because whatever your approach is, the impact can be found within that approach. The third is impact at scale. So your story will focus more on how you are delivering impact through a scalable business model. Delivering impact, it is the main focus. In my opinion, Light of Hope will fall under this, where they're delivering impact, they have a scalable business model to do so. And the last one is addressing an underserved need. What this means is your target market someone who is previously underserved, maybe because they are from low to middle income, where they're not able to kind of afford these services? And if so, is there a financially viable approach that you have that others do not, that helps you basically enter this market? This is also quite popular with non-profits especially, but also for-profits are coming up with innovative mechanisms to tap into underserved markets with interesting business model. So one thing you need to be particularly careful for this is you do not get across to your investors as if you're exploiting the underserved market. So especially if you're saying that these people do not have money to pay for X, Y, and Z, you must be able to convince the investors that, hey, they do not have money, but our service gives them this, and you need to convince them who is the one paying you, and make it clear to them that you're not exploiting the target group that you're serving. What exactly do each of these investment stories need to focus on? So for a high growth opportunity, you need to focus on the fact that there is significant revenue traction, you're working on a large market opportunity, and that you have a profitable unit model. For example, I think a bamboo company would be a good fit for a high growth opportunity kind of angle, where basically you have a good unit model, you have an understanding of what the market opportunity is, and you have a revenue traction. All right. And when investors are looking to invest in you, they will expect market rate returns. So this is to say that they will expect the same returns as when they invest in a normal startup. But also the impact that you're bringing in, there's also a motivation for the investors. That is basically the tipping point for normal investors to come to you, because they know that they are able to get expected market returns, but also with the addition of an impact. So the next thing is the innovation play. So innovation play, you need to focus a lot on how your solution is unique and how it is exciting. All right, because you're essentially saying that you want to disrupt a market, an entire industry. You need to also show them that, okay, if I'm disrupting the industry, is the industry big enough for me to actually disrupt and be sustainable financially? You need to show them how big the market opportunity is. And also you need to convince basically your investors that your industry, or at least paint a vision to your investors that, look, if our solution is implemented, the industry in 5-10 years will look like this, and it will look drastically different. This is the kind of thing Uber or Grab or Gojek tells people. When everyone has a Grab or Uber app, this is how ride sharing will be transformed. So that is a picture you need to paint for the investors. And investors in this area usually have a high risk tolerance, because these are players looking to really disrupt. So when I mean high risk tolerance, is they are able to put up upfront large financial sums, basically with the expectation that I need to wait a bit longer, or I'm okay if you guys fail because I have a lot of other such investments. The third angle, impact at scale. Basically, you need to focus on your impact thesis or the theory of change. We have gone through how do you come up with a theory of change. Another thing you need to focus on is why are you working in the market, and how are you different from the mainstream players that are currently in the market. Impact and financial return, in this case, they need to go hand in hand. Basically, this angle requires your impact to be front, but also have a very, very viable financial return model. The last thing is investors in this area, they have a medium to high risk tolerance, and they may or may not be impact motivated, but most of the time they are impact motivated, because that is the kind of narrative you're pushing across, that you have a strong impact thesis. And the last one is basically those who are addressing an underserved need. You also need to focus on your strong impact thesis, theory of change, and you also need to show that you are working in a market that people usually ignore. This can excite investors because you're entering a new market, and you also need to basically convince them that even though I'm entering this underserved market, I'm not exploiting any disadvantaged people or underserved people in this area. And this can either be a non-profit or for-profit structure. And of course, if you're a non-profit, you are not going to ask for equity funding or so on. You're just going to ask for grants or some other form of support. And this is where your main focus is really impact investors with high risk tolerance, and also foundations who are willing to basically peg a dollar amount to the impact that you're making.